Most people were taught that debt is dangerous. And honestly, for most people, it actually is. But here's what they never teach you in school. The wealthiest people in the world are not avoiding debt. They're using it strategically, intentionally, and most importantly, profitably. So today I'm going to show you exactly what I mean and exactly how you can apply this in your own life. And before we get into the 5 ways, I'm going to share a rule that separates the people who build real wealth with debt from those who just get buried by it. It's called the 30% rule. And once you understand it, you will never look at debt the same way ever again. So the 30% rule is only use debt when your expected return on the capital is at least 30% greater than the cost of that debt. If a loan costs you 8% per year, your investment should generate at least 10.4% annually before you even consider taking it on. Why 30%? Because that buffer accounts for risk, which a lot of people just don't factor in, as well as market shifts and just other things that you can't predict. Wealthy people do not borrow to break even. And I've made that mistake in my life earlier in my career. I borrowed money to purchase a property that I thought was going to provide income, and the numbers didn't check out because I didn't account for the risk involved. And ultimately I was breaking even, and in some cases even bleeding some money. And that was an asset I had to let go of, and I lost money on it. So wealthy people borrow to build a meaningful gap between what they pay and what they earn. That gap right there is where real wealth is created. So keep that in your head, and now let's get into the 5 ways. Number 1, using debt to acquire cash flowing assets. This is the most foundational, the most widely used. Wealthy people use debt to purchase assets that literally pay for themselves. The clearest example is income producing real estate. You put 20% down on the property, you borrow the other 80%, you're not paying that mortgage, the tenant is. Every month the rental income covers the debt, and you keep the difference. This is called cash flow arbitrage. You are using borrowed money to generate income that exceeds the cost of borrowing. And here's what makes this compound over time. While the tenant pays down your mortgage, the asset is also appreciating in value over time. A decade later, you've now built equity on an asset that you never even really fully funded yourself. This is how one property becomes 3 and then it becomes 10. Debt is the tool, but cash flow is the engine. So just using simple math here, let's just say you buy a condo and all in the mortgage is gonna be $5,000 with all of the fees and taxes, and you're in a place where you can rent out that condo for $7,000 a month. That is an example of an asset that would excite me because I know that to service the debt in the property, it's gonna cost me about $5,000 per month. However, I can rent it out for $7,000 a month. So that's $2,000 in my pocket every month. And on top of that, my condo I know is going to continue to appreciate year after year, and an asset that I'm going to keep it ultimately in the long run. It's going to be another retirement asset that's ultimately paid off by somebody else that I can rely on. Number 2, the debt tax shield. This one is way less talked about, but it's one of the most powerful tools available. Here's how this works. In most cases, interest paid on debt used for investment or business purposes is tax deductible. So if you borrow $500,000 at a 7% interest rate, you're paying $35,000 a year in interest. But if you're in a 35% tax bracket, the government effectively subsidizes $12,250 of that cost. So the real cost of your loan just dropped by 4.5%. Wealthy people structure their debt intentionally to capture this benefit every single time. They use business loans, investment property financing, and secured business lines of credit to do so. Because they understand that the after-tax cost of debt is almost always cheaper than the rate on paper. Most people see the interest rate, they don't actually think about the net rate. And that distinction is literally worth thousands, sometimes hundreds of thousands over the life of the loan. Number 3, borrowing to preserve liquidity. I love this one. And this is one of the most counterintuitive strategies that I know. And it is used heavily with high net worth individuals. Here's the situation. You have $300,000 in investments. Your portfolio is compounding at 12% annually, and a great opportunity comes along and you need $100,000. The average person sells that investment to cover the cost. What does a wealthy person do? They borrow against their assets. They take out a secured line of credit, they use the $100,000 to buy that asset or the property, and they keep their portfolio fully invested in the stock market. The investment continues to compound 12% year over year, and let's just say the loan cost them 5%, for example. 7% that they're earning on capital, they never had to liquidate. Now, again, keep in mind the stock market does not grow every year by 12%. If anything, in the long term, it averages about 10%. But a diversified growth portfolio, 10 to 12% of the market, leaves that gap so that there's the ability to earn on that capital. This is often why you're gonna see or hear about wealthy people taking out loans, even though it doesn't seem like they may need more money for any reason. They do that because you don't have to pay taxes on debt. They're not borrowing because they're struggling. They're borrowing because they've done the math and they know that loan is gonna allow them to make more money somewhere else. So liquidity is power and preserving it is a strategy. Number 4, using business debt to scale revenue. This is where some of the most significant wealth acceleration can happen. When a business is generating consistent, predictable revenue, borrowing capital to scale that business can produce returns that no passive investment can match. Think about it this way. If every $1 that you infuse into your marketing system returns you $4 in revenue, and you can borrow $200,000 to deploy into that system, you just generated $800,000 in revenue with someone else's money. Your loan costs you $14,000 a year. Your return is $600,000 in profit. That's not a debt trap. That's a money machine. The key difference between sophisticated business owners and everybody else is this. Sophisticated owners know their unit economics cold. They know their cost of acquisition. They know their margin. They know what every single dollar of capital deployed will return in the future. That clarity is what makes business debt safe. When you don't know those numbers, debt is very dangerous. But when you do, it can be an accelerant. And then number 5, locking in today's prices with tomorrow's money. This is about economics and timing. Inflation simply means that money loses purchasing power every single year, or basically everything gets more expensive each year. So borrowing today at a fixed rate to buy an asset that will be worth more in 5 or 10 years is a hedge. You're locking in today's prices, but then you're paying back the loan with tomorrow's cheaper dollar. If inflation runs at 3 to 4% per year and your fixed loan rate is 6%, the real cost of your debt is closer to 2%. And if that asset appreciates by about 7% per year, you've now turned the 2% debt cost into a net 5% gain. This is how institutional investors and high net worth individuals think, in real terms, not nominal terms. They don't just ask, what does this cost me today? They ask, more importantly, what will this be worth when I pay it back with cheaper dollars in the future? Most people have never framed debt this way, but once you do, you cannot unsee it. That's the beautiful part. So let's recap where we're at. 5 ways to utilize debt. Number 1, acquire cash flowing assets that pay the debt for you. Number 2, use the tax shield to reduce the real cost of borrowing. Number 3, borrow against assets to preserve liquidity and keep capital compounding. Number 4, deploy business debt where the return significantly exceeds the cost. And then number 5, buy appreciating assets today and pay back the loan with tomorrow's cheaper dollar. And through all of it, the 30% rule applies. Only use the debt when the spread between the cost of borrowing, but now here's the part that people miss, and your expected return is significant enough to justify the risk. That's the filter that every financially sophisticated person runs before signing anything. Now, I want to be honest with you about something. Understanding these 5 strategies at a conceptual level is one thing. Executing them correctly in your specific situation is a completely different thing. Knowing which one applies to you right now, in what order and at what scale, how to assess the risk, that's a completely different situation. And you don't want to do that just off the cuff. It requires a clear picture of where you are, where you want to go, and a plan that's going to be built around your numbers, not someone else's. And that is exactly what we do. In the 90-day financial planning program that I developed especially for our high income earners and people who already have some wealth to their name, but don't have a system, don't have a strategy, don't understand how all the pieces play a role with one another and how they communicate, how to leverage a investment portfolio into your real estate portfolio and vice versa, how to really acquire assets using good debt. That is what my 90-day program is all about. You will walk into that program not knowing what you're doing with your money as a whole, feeling like you've plateaued in where you've gotten yourself so far, knowing that there's so many other goals that you can work towards, you just don't know where to start. or what to do next. And I will educate you on every pillar of building wealth from the ground up so that you have a 12-month roadmap, very clear goals, and a very good understanding of how all these things work so you can manage your behavior when the stock market goes crazy, when interest rates change. You know how to adapt. You're gonna leave that program with a high degree of confidence and understanding so that you can start to navigate the rest of your financial life with tools, foundational knowledge, and education that you will carry with you forever. I'm Andrew. If you'd like to apply to our program, because not everybody's gonna be accepted, you have to fit a certain financial profile for this program to make sense for you, go to www.thefinancialhouse.com and click the Start Now button to apply now.